Good evening, MBA 503 students. This is the second recording in the series of recordings on Module 4, Financial Statement Analysis. Okay, so what we're going to talk about, in the last recording, we did the inputs to financial statement analysis. Now we are going to look at liquidity ratios, which is the first set of ratios. There's 13 total ratios, and they're divided into 4 groups, and we'll go over that in a second. Okay, so let's go to the PowerPoint here and start the slideshow. Okay, so the basic method for analyzing financial statement is to compute ratios. In general, these ratios measure a company's financial position and performance. Okay, and there are 13 ratios, and they're divided into 4 things that they measure. First one are liquidity ratios, measure a company's ability to pay its short-term debt. Very important. If you can't pay your short-term debt, you're out of business. Secondly, some people call these solvency ratios. More people call them leverage ratios. And these ratios measure a company's ability to pay its long-term debt, most notably bonds. Shareholder ratios. Shareholder ratios measure how much a company is benefiting its shareholders, both in terms of whether the stock is appropriately valued and the amount of dividends the company pays. And then accounting return ratios measure a company's returns to investors as measured from an accounting perspective. Okay, let's get right into the liquidity ratios. Okay, and I'm actually going to be going back and forth between this spreadsheet and Pfizer. Okay, the first ratio is the current ratio. And the equation for the current ratio is very easy. And this is why we classify between current and non-current balance sheet accounts. Simply, you take your current assets, divide by your current liabilities, and this ratio tells you, gives you a general indication of whether or not you have enough assets that are going to be turned to cash within a year over current liabilities, which are obligations or debt that you have paid within a year. Obviously, you want this ratio, the higher the better. It's better to have a 2 ratio, 2 to 1 current assets, current liabilities, or 3 to 1 than 1 to 1. Once you go under 1 to 1, then that signals a red flag. Okay, so let's go over here. Yes, I'm going to be going back and forth. And this is where we stopped this worksheet last time. We had all the inputs here, and we'll be sharing those inputs later. Okay, but anyway, so here are the ratios. And I've given you the denominator, the numerator, and denominator of all these ratios. So for the current ratio is current asset. The numerator is current assets. The denominator is current liabilities. Okay, so it's a very easy ratio. Okay, and I'll put the word ratio out here. Ratio. Okay. And so all I'm going to do, this is all balance sheet based, assets and liabilities, nothing from the income statement. Okay, so we're going to say the numerator is, we just go to the balance sheet, which I put right next to it, and we will go to total current assets. So our total current assets are equal to 32,803, and our total current liabilities also from the balance sheet. Total current liabilities have to go down here to the liabilities section. And total current liabilities are 37,301. Okay, so Pfizer had a total current ratio for the year ended 2019 of current assets divided by current liabilities of about 88%. Now that's not, we like that to be for at least $1, but that's not that's not generally. I mean, this is an initial indication that maybe they could have better coverage of the current liabilities, but we'd like to be 1. But you'd have to take a look at the entire structure. Maybe if there's long-term investments, marketable securities that the company's holding, and they could shift those into current assets, sell them, and pay off the current liabilities. So you have to look at the general balance sheet. But generally speaking, this ratio might be a little low, but I believe that Pfizer handles its cash flow. Okay, now the next ratio, let's go back here to the PowerPoint, and The next ratio is the quick ratio. Okay, and this this ratio is a variation of the current ratio. Notice the denominator is current liabilities. And notice on top you have the most liquid assets on any balance sheet. Cash, which is the most liquid asset you can have. Liquidity means having a lot of cash, by the way. Accounts receivable, which are converted to cash when you collect it. Remember, accounts receivable is money that's owed to you by others. Well, it's a current asset, so we expect it to come within a year at least. Then marketable securities. If you have securities, treasury bills, stocks, whatever, and there's a market for them, that's why you use marketable securities, you can sell those things directly for cash. Okay, so if you read my description, it says this ratio measures whether a company has sufficient cash or near cash assets, referred to as quick assets, to cover its current liabilities. This ratio is similar to the quick ratio. They both have the same denominator, which are current liabilities, but only includes the numerator, only includes cash and the most liquid assets. Okay, it excludes inventory because inventory is not sufficiently liquid, and prepaid expenses because you can't use an expense that you paid in advance to pay off current liabilities. Prepaid expenses, by the very concept, cannot be used for that purpose. Okay, so let's go back to the worksheet here. So our quick assets. Quick assets is the numerator. So quick assets, and quick assets are equal to, let's go back up here, cash and cash equivalents plus marketable securities. Short-term investments are the same thing as marketable securities, and trade accounts receivable. So notice that the balance sheet, the top three accounts on the balance sheet are the most liquid by definition. Okay, so that's our numerator, the sum of cash plus short-term investments and trade accounts receivable. Okay, so that gives 18,554. Okay, and current liabilities, well, we know what current liabilities are. Let's just make that equal. Okay, and our current ratio comes out to be 0.50. Now, notice what we did is we took out stuff like inventory, which may not be too liquid, but there's various reasons for leaving out inventory. But it's not the most. But by using only, and we took our prepaid expenses and other assets, but only using the company's most liquid assets, then the current ratio says that very liquid assets, you only have 50 cents per liquid asset, per quick asset, to pay off every dollar in current liabilities. And that's the same for the current ratio. It's saying you have more or less 88 cents to pay in current assets to pay off your current liabilities. But when you only include the most liquid ones, that ratio goes down to 50 cents. So more or less. So you have 50 cents to pay off your current liabilities. Okay. Now we go down here to what we call turnover ratios. Okay, in turnover ratios, I'm going to put a little description here. Well, I'll go back to the PowerPoint here. It should describe it very neatly. Okay, so there's liquidity ratios. Next one is accounts receivable turnover. Okay, so be careful with this. Now, the numerator is credit sales. Companies sometimes, and analysts sometimes just use total sales. Sales can be either for cash or on credit, with a credit card, for instance. Okay, so sometimes we just use credit. We use total sales rather than credit sales, even though it's not theoretically correct. It's just become a habit of a lot of people. So I'll be using total credit sales, right? And then or I'll be using total sales for that, which includes both cash and credit sales. I believe that for Pfizer, there are probably a lot of credit sales, but that's something that we'll ask maybe somebody. Anyway, it's over average accounts receivable. And look what I have. For average accounts receivable, what we're doing is going to take the beginning accounts receivable, the ending accounts receivable, and put it all over 2. You're going to notice that in a lot of these ratios, in 4 of them, we use the average account balance. That means you're going to take the beginning balance, the ending balance, and put it all over 2. And what does this ratio measure? The ratio measures how many times the company has collected its average accounts receivable during the period. The higher, the better, and faster. You want to collect your accounts receivable as many times as possible. And I'm going to show you on the worksheet, I'm going to show you a variant of this ratio. Okay, so let's go over here. And we're going to take credit sales. Now, even though this is theoretically not correct, a lot of analysts just go to the statement of income, and they take total sales, which should be total net sales. Okay, so they'll take total revenues of 57,570. Okay, now average accounts receivable, remember, I'm going to take the beginning plus the ending over 2. So we're going to go to the consolidated balance sheets. The beginning accounts receivable for Pfizer was $8 billion. We're going to add to that the ending accounts receivable for 2019, which was $8.7 billion. And we're going to divide all that by 2, and it should come out to 8 billion something, obviously. That looks fine. That looks good. Okay, so what we're going to do is we're going to divide credit sales. Really, we took total sales. Just a lot of people just do that for a shortcut. And so we get a number of 6.17. This means that I'm going to say times collected. Okay, that means the higher this number, the better. That means that you collected your average receivable balance 6 times this year. You want to collect receivables as fast as you can. A receivable is worth nothing unless you ultimately collect it. And we'll deal with that later in the chapter, but it makes sense that you don't want people owing you money. You want people paying you money. Okay, now I'm going to go over here and just do a variant on the accounts receivable turnover, and we're going to call this days collection. Or, people have different names for this, but all we're going to do, it's just another way of expressing the accounts receivable turnover ratio. Is you take the accounts receivable turnover, I'll just call it ART, excuse me, ART. Just take the ART ratio, accounts receivable turnover. ART stands for accounts receivable turnover. And what we're going to do is we're just going to take the accounts receivable turnover and divide it by the number of days in the year. Let's just use 365 as a rule of thumb. And we're going to use 365, and this is days. That's the days in the year. Okay, so let's see what we get. If you center this, I'm going to count. I like to figure all these things out. So if you take the accounts receivable turnover ratio, which is 6.17 times, and we divide it by 365, excuse me, 365, what we're going to get is a number of days. The number of days it takes us to collect those amounts. Oh, excuse me, I did this backwards. I don't know what I'm thinking sometimes. You're going to take 365 and divide it all over the accounts receivable turnover. Okay, and we'll put a line there. So sorry about that. Okay, so we'll take 365 and divide it by the accounts receivable turnover, which is equal to this number here. And we're going to get about 60 days. So that means that you collect your accounts receivable, that Pfizer collects its accounts receivable about every 2 months, 60 days. Now you want this number to be as low as possible. Now I'm not going to say whether this is bad or good, because you really have to compare this to other pharmaceutical companies. But the lower the better. So you want this ratio, the accounts receivable turnover, to be as high as possible. And what that's saying is you've collected your receivable balance just about 6 times, a little bit over 6 times this year. And if you take 365 and divide it by the accounts receivable turnover, that means that translates into about 60 days. You want those 60 days to be as small as possible. As the accounts receivable turnover here gets larger, which is what you want, the days collection gets smaller. Okay, and that's what you want. You want to collect your receivables as fast as possible. So we're looking at about a 2-month collection period. You really have to compare that on an industry basis. Okay, let's finish this up here, and we'll go back to the PowerPoint. Okay, go back to the slideshow here from current slide. Okay, so there's your accounts receivable turnover. This is your final ratio here, the inventory turnover. Now notice that it looks very similar to the accounts receivable turnover, and it is. This ratio measures how many times the company has sold its average inventory balance during this period, and the higher, the faster, the better. This is very important. You want, by the way, that's say inventory turnover. This is inventory turnover, so I have to change it to IT. Okay, when I do the class, I'll change all these things. But this is inventory turnover. It should be IT. I didn't see that. Anyway, but you want this ratio to be as high as possible because you want to sell your inventory as fast as possible. One of the most damaging things a company can have is inventory that it can't sell. If you make products, you can't sell them. You have to take the price of the inventory down to try to sell them, or maybe it's so obsolete you can't sell them. Okay, so let's go over here to the slideshow here. So let's go over here to the slideshow and see how you would calculate the inventory turnover ratio. And as last part, I'll make that correction on the slide. Okay, so inventory turnover, IT, is equal to, remember what it was, is equal to cost of goods sold. And remember the cost of goods sold is the cost of the inventory that you sold. So that, in a sense, is inventory flooding out the door at cost. Okay, so let's see what we got here. We go to the income statement. Notice that we're going one line beneath. So the income statement is Pfizer's cost of goods sold was 10,219. Okay, these are in millions. Okay, now your average inventory. All the averages are calculated as beginning balance less ending balance divided, or plus ending balance divided by 2. So let's do this. We're going to go back to the balance sheets, and we're looking at inventories. Your initial balance was 7,508. Then we're going to add to that. The ending balance was 8,283. We'll put it in parentheses, and that's your denominator. Okay, so this says I want to check these numbers because it's a little low. That was, I just want to make sure, it's starting to look a little low to me. That was, your cost of goods sold was 10,219, and your average inventory was in the low $8 billion range or high sevens. Your inventories, we're looking like we're getting good numbers. Okay, so our inventory turnover, equal to that. I could just copy it down. It's equal to less than 1, which to me signals, I don't know, it signals a concern. I don't know. So I'm going to label this times inventory sold. Okay, and so it's less than 1, which seems strange, but this is the way the ratio is calculated. Okay, I'm going to call this days to days to sell inventory. Okay, so once again, we're going to take 365. We're going to divide that by the inventory turnover, the IT, the inventory turnover. Okay. And it's very rare you're going to get a number like this. But this is going to tell us, we're going to take 365 and divide by the inventory turnover number, which gives us 564 days. So that's telling us that it takes more than a year to sell the inventory. Wait a minute, we're going to take, that's the same thing, 365 and divide by, just to be equal about this, but the result is fine. We're going to take 365 divided by the inventory turnover of less than 1, which you rarely see. This is divided by 0.647. Maybe that's the industry. I don't know this industry that well. So it takes 564 days on average to sell the inventory, according to the financial statements. So maybe we'll, as a class, we'll look more into that number, or maybe somebody who's you're all specialists, know more about your own company than I do, obviously. Okay, so this means that it takes a year and a half to 3 quarters to sell the inventory balance. This is definitely, we're going to have to look at some. Usually inventory turnover is larger than 1. So I'm going to put a red X by this. And I think as a class, I want to put this in bold. That as a class, we'll take a look at this, and I'm sure we'll be changing it from what's on this video. But anyway, that gives you an idea of how these liquidity ratios work. This means, current ratio means that for every dollar of current liability, there's 88 cents of current assets to pay off that current liability. This says that for every dollar of current liability, there's 50 cents of very liquid assets, cash, accounts receivable, marketable securities, pay off current liabilities. This says that, this looks respectable in a sense. It says that accounts receivable collected 6 times a year, which translates into about 60 days, 2 months per year. And then the inventory turnover is basically saying that you collect inventory about 65 times per year, 65.65 times a year, 0.65 times, which translates into about 564 days. The higher both these turnover ratios, the better. And the reason that these two, the turnover ratios, are important is you're not just interested in seeing what you can cover now. It doesn't matter what you can cover now, but you've got to know that you're going to collect your receivables and turn them into cash in order to start measuring whether or not this current ratio is valid. If you don't turn receivables, remember this includes all current assets, including cash and accounts receivable. If you don't collect your accounts receivable, then this current ratio may not mean anything. Same for inventory. If you don't sell your inventory and convert it to accounts receivable or cash, it means nothing. Anyway, so I'm going to go back here to the slideshow here. I don't know why I'm doing this, but there's the inventory turnover ratio, and I'm going to stop right there. And in the next video, we're going to get into the two leverage ratios. So these look at whether or not you can pay off your current liabilities. The next ratio, your short-term debt. The next ratio is going to measure whether or not you can pay off your long-term debt, bondholders. Okay, so have fun in your accounting adventures, and I'll see you on Tuesday. Okay, so here we go. We're going to stop right there.